there is a three-digit number that decides whether you can rent an apartment, what interest rate you pay on a car loan, how much your insurance costs, and in some states, whether you get a job offer. You didn't vote for it. You didn't agree to it. You were never asked if you wanted to participate. And the formula that produces it is a legally protected trade secret, meaning the people it affects the most, which is everyone, are not allowed to know exactly how it works. That number is your credit score. And the system behind it is one of the most powerful, least understood, and least questioned financial structures in modern American life. Today, we're going to change that. Because once you understand where this system came from, how it actually works, who profits from it, and what it's quietly becoming, you will never think about that three-digit number the same way again. Let's go back to the beginning. Because this story starts in a place you would never expect. It starts with a mathematician named Bill Fair and an engineer named Earl Isaac sitting in a San Francisco office in 1956, trying to sell a genuinely radical idea to a banking industry that thought they were out of their minds. The idea was simple. Instead of a banker looking a loan applicant in the eye, judging their handshake, their neighborhood, their name, and their general vibe, you could use math. You could collect data points about a person's financial behavior, run them through a formula, and produce a single number that predicted the likelihood they would repay a debt. Objective, consistent, scalable. Fair Isaac Corporation, FICO. That's where the name comes from. Two guys in 1956. And here's the part that gets interesting. The banks hated it at first, not because it was wrong, because it threatened the relationship. Because a banker who controls credit based on personal judgment controls something valuable. A formula doesn't need a banker. So for the first 30 years of its existence, the FICO score was a niche product used by a handful of lenders. Most banks kept doing it the old way. Gut feeling, personal relationships, and in many cases, naked discrimination. Then 1989 happened. FICO released its modern scoring model and partnered with the three major credit bureaus, Equifax, Experian, and TransUnion. And suddenly, the score had distribution. By the early 90s, Freddie Mac was recommending that mortgage lenders use FICO scores in underwriting. And just like that, the three-digit number went from a niche analytical tool to the de facto infrastructure of American consumer credit. Not because Congress mandated it, not because voters chose it, because the mortgage industry decided it was convenient. And convenient it was, especially for the people selling the scores. Here's how the money actually flows. And pay attention here because this is where the whole thing gets uncomfortable. The three major credit bureaus, Equifax, Experian, and TransUnion, are private companies. They are not government agencies. They are not public utilities. They are for-profit corporations whose entire business model is built on collecting your financial data without your active consent, packaging it, and selling it to anyone willing to pay. Lenders, landlords, employers, insurance companies, car dealerships. Your financial life is their product, and you are not the customer. You are the inventory. Equifax alone generates over $5 billion in annual revenue. Experian clears roughly $6 billion. TransUnion pulls in around $4 billion. Combined, the three bureaus are running a roughly $15 billion per year business entirely built on data that belongs to you, that you cannot meaningfully control, and that you are legally required to engage with if you want to participate in the modern economy. And then there's FICO itself, which charges lenders every time they pull a score, somewhere in the range of $1 to $3 per inquiry. That sounds small until you realize there are roughly 3 billion credit inquiries made annually in the United States. The math handles itself. Now let's talk about the score itself. Because most people interact with their credit score the way they interact with the weather. It changes. They check it occasionally. They have a vague sense of what causes it to go up or down. But the actual mechanics? Almost nobody knows them. And that's not an accident. The FICO score runs from 300 to 850. It is calculated using 5 categories. Payment history at 35%, amounts owed at 30%, length of credit history at 15%, credit mix at 10%, and new credit at 10%, straightforward enough on the surface. But here's where it starts to get genuinely strange. Your credit utilization ratio, the percentage of your available credit that you're currently using, accounts for a massive chunk of that 30% amounts owed category. And the conventional wisdom is to keep it below 30%, Fine. But here's what nobody tells you. The score doesn't care why your utilization is high. It doesn't distinguish between someone who maxed out their card on a medical emergency and someone who maxed it out on a trip to Las Vegas. Same utilization, same score impact. The formula has no context, it has no judgment, it has no humanity. It is purely behavioral pattern recognition dressed up as a measure of financial character. And the length of credit history component creates one of the cruelest catch-22s in personal finance. To build a good credit score, you need a long history of credit accounts. But to have a long history of credit accounts, you need to have been given credit. And to be given credit, you generally need a good credit score. Young people, immigrants, and anyone who grew up in a household that avoided debt on principle are structurally penalized by a system that mistakes inexperience for risk. Meet Marcus. Marcus is 26. He grew up in a household where his parents paid cash for everything because they'd seen debt destroy relatives. Smart, actually. Disciplined. But Marcus has no credit history. He applies for an apartment in a decent neighborhood. Denied. He applies for a car loan to get to his new job. Approved, but at an interest rate 4 percentage points higher than someone with an 800 score would pay. Over a 5-year loan, that difference costs Marcus roughly $3,000 extra. Not because he's a bad financial risk, because the formula doesn't know him. And in the absence of data, the formula assumes the worst and the errors. Let's talk about the errors, because this is the part that should make your blood pressure move in a meaningful direction. The Federal Trade Commission conducted a study finding that roughly 25% of consumers had at least one material error on their credit report. 1 in 4 people. Errors that were significant enough to potentially affect their creditworthiness. We're talking wrong account information, debts that belong to someone else entirely, accounts that were paid off still showing as delinquent, identity theft consequences still sitting on reports years later. And the dispute process? It is a masterclass in bureaucratic friction. You submit a dispute to the bureau. The bureau sends it to the original creditor. The creditor has 30 days to respond. In many cases, the creditor just confirms the original information without actually investigating it. The bureau marks the dispute as resolved. Nothing changes, and you start over. Meanwhile, the error is still affecting your score, your insurance rates, your rental applications, your loan terms. Every single day, the process drags on. In 2013, the 3 major bureaus settled with state attorneys general and agreed to reform their dispute processes. In 2017, they settled again over similar issues. The reforms happen. The problems persist because the financial incentive to maintain a frictionless system for lenders is much larger than the financial incentive to build a frictionless system for consumers. But here's the part of this story that most people haven't caught up to yet. Because everything we've talked about so far is the old version of the problem. The version that's been quietly building for 60 years. What's happening now is a whole different level. The credit score is expanding. Not just in how it's used, but in what it measures. Insurance companies in most states are now legally allowed to use credit scores to set your premiums. Not your driving record, not your claims history, your credit score. Multiple studies show that people with lower credit scores pay significantly more for car insurance than people with identical driving records but higher scores. In some states, the difference is over 50%. You can be a perfect driver who never filed a claim in your life and pay more than someone with 2 accidents, simply because you had a medical debt collection show up on your report 3 years ago. And then there's employment screening. Roughly 30% of employers now run credit checks on job candidates. And here is the darkest irony in this entire story. If you lose your job, your credit score tends to fall because you can't pay your bills. And because your credit score has fallen, it becomes harder to get a new job. The system designed to measure financial responsibility actively punishes people for experiencing financial hardship. It is a trap with a credit bureau logo on it. And the newest frontier is what some researchers are already calling alternative data scoring. Buy now, pay later history, rent payment data, utility payments, bank account cash flow patterns, cell phone payment history. The bureaus and fintech companies are actively working to incorporate all of this into expanded consumer profiles. On the surface, the pitch is inclusion. Give people without traditional credit histories a way to build scores. And that part is real. But the other side of that coin is a surveillance infrastructure that captures an increasingly comprehensive picture of your financial behavior and sells it to an increasingly wide range of buyers. The three-digit score was just the beginning. What's being built now is a financial identity layer that touches almost every economic decision you make. So here's what you can actually do right now, because understanding the machine is only useful if it changes your behavior inside it. Check your credit reports immediately. Not your score, your actual reports. You are legally entitled to one free report from each bureau every year at annualcreditreport.com. Pull all three, read them. Look for accounts you don't recognize, incorrect balances, duplicate entries, and anything that doesn't look right. If you find errors, dispute them in writing, send everything certified mail, keep copies, and be prepared to follow up multiple times. Keep your credit utilization below 10% if you can manage it, not 30. 10. The score rewards low utilization aggressively. If you have old accounts you don't use, think carefully before closing them. Closing an account reduces your available credit and shortens your average credit age, both of which hurt your score in ways that take months to recover. And if you're building credit from scratch, a secured credit card used for small recurring purchases and paid in full every month is still the cleanest on-ramp available, because the system isn't going away, it's expanding. And the less you understand it, the more it costs you. Not in some abstract way, in actual dollars. On every loan, every insurance policy, every rental application for the rest of your financial life. The credit score started as a mathematician's formula to remove bias from lending. And in some ways, it did exactly that. But what replaced the bias wasn't neutrality. It was a different kind of structural disadvantage, one that compounds quietly over time, that profits private companies to the tune of $15 billion a year, and that most people accept as a natural feature of modern life, rather than a 50-year-old business model that nobody ever asked them to vote on. So here's where I want to hear from you. Do you think the credit score system is fundamentally a net positive that just needs better regulation and error correction? Or do you think the whole structure is rotten enough that it needs to be rebuilt from scratch? And honestly, when was the last time you actually looked at your full credit report? A. Recently, and I found something wrong. B. I check my score, but I've never read the actual report. Or C. I've been meaning to and keep putting it off. Drop it in the comments. Because option C is where most people live, and the bureaus are counting on it.